So let's use a broad example for a public company. Again, public company, broad objective. Remember our objectives, their operating objectives, their financial reporting objectives, their compliance objectives. Broad objectives, I'm a leader of a company. My team here is, we intend to maximize shareholder value through growth and profitability. All companies have that at least as a baseline objective amongst many others. Sub-objectives, I want to increase revenue, I want to decrease cost, that's going to increase profit. Everyone's going to be happy around that because the analysts are going to say, wow, look at the good job we're doing. We can expect that these profits will continue to increase over time with the strength of this team. That improves the net present value, future cash flows. The stock price is going to go up. Everyone's happy. So those are our sub-objectives as a public company, let's say. So from a financial reporting perspective, our broad objective is to produce financial statements that are free of material misstatement. And our sub-objectives then relate to that are all assets on the balance sheet exist, all revenues occurred, that they existed as they're shown. There are no fabricated revenues. We don't want to have revenues in there that somebody booked before the product was shipped. That would be a problem. That's a control deficiency. If that's a significant deficiency or a material problem or material weakness, then you have problems with your financial statements where you cannot say they're free material misstatement. So that is sub-objective we want to satisfy. And all transactions that have occurred are recorded in the financial statements. We have this completeness objective satisfied. So again, you can think about all the areas in the financial statements. We want to ask these basic questions: existence, completeness, valuation and allocation, rights and obligations, presentation and disclosure. If we've satisfied those sub-objectives, then we can be confident that we've produced financial statements that are free of material misstatement. We have many financial reporting objectives, and we have to adhere to the same process around all those objectives in terms of understanding what the objective is, or the objectives are, what the risks may be, and how we properly control them. So let's use an example. So an objective and again, we're going to have many inside our company. One of our objectives might be occurrence of sales. And what does that mean? Well, that means that we have an intent to properly represent the actual delivery of goods and service to our customers, and we want to properly record that, and we have an objective to report revenue correctly. Okay, so the occurrence of sales. And again, this is an example where existence is an important assertion here, where if we have said something is in our ledger as it existed, that means that it better have existed, and we better have the controls around that properly so that we're recording revenue correctly. And remember, revenue is a very important area of the financial statements because investors are really interested in how organizations are performing in prior periods compared to last year, how they are performing compared to forecast in terms of what their trend line looks like. It's a very important area. So occurrence of sales is an objective. We want to get that correct. Okay, so our next level down is we have to identify, well, what are the risks when it comes to the occurrence of sales? Well, what happens if we record a sale by a customer before it is actually shipped? So for example, the customer order came in, it was supposed to ship today. For whatever reason, things got backlogged down in the warehouse where the product was supposed to ship. The truck didn't actually leave, but our system recorded it as a sale anyway. We've recorded a sale and the goods actually have not left yet. That's an example where we've recorded revenue and it actually hasn't occurred yet. Because the standards, our revenue recognition standards tell us that you record revenue when it is earned, and basically that means when the goods or services are transferred to the customer. So we have an objective, proper occurrence of sales. We have a risk. What happens if we record a sale before it is shipped? So that is a legitimate risk depending on the kind of business you're in, where you might not have strong connections between what happens in your warehouse and how the sales order process actually is managed, say back in the corporate office. So you want to put controls in place. Okay? In that example, the best way to do that is to have an automated control. Okay? You'd want an automated control. You wouldn't want a system that relies on somebody waiting for paperwork to come back to the office so you know something happened. You'd want automated control. And that automated control would be designed such that when the inventory actually ships, then it triggers a flag in the sales order system, yes, and that matches a date, and you have properly ensured that the existence of revenue is aligned with the date on which it occurred, and you can feel confident that your revenue is properly recorded in your general ledger. Principle 2 for management. For public companies, management has to evaluate evidence should be based on the assessment of risk. This is a risk-based approach. So management should focus on the areas of higher risk and assess the operating effectiveness of controls. Okay, so what does that say? That says we have all kinds of processes and events that go on in an enterprise. And you can imagine what the guidance is telling management is to focus on the areas of higher risk. I guess that's somewhat obvious. What they're saying is you don't have to, in fact, examine the controls across everything that exists in your enterprise. You have controls throughout. Areas of higher risk, moderate risk, lower risk. The emphasis here obviously is on areas of higher risk. So the key questions to consider is the control operating as designed and by a person with appropriate authority and expertise.